95% of traders out there have FOMO and enter their trades too early. But there's a rule that tells you exactly when to pull the trigger. I've saved tens of thousands of dollars over 1,000 trades just by following this rule. In this lesson, I'm going to teach you the 3-day rule that will help you get rid of your FOMO once and for all. The 3-day rule is a very simple rule, and it's used whenever the stock gaps up or down. The rule simply states we should wait at least 3 days after this gap up and down to help us wait for a top or bottom to form. Now, there's a reason why we need to wait 3 days and not 1 day or 2 days. The reason is because retail panic selling usually lasts more than 1 day. The second reason is institutional players, even if they want to exit, because of the sheer position size that they have, which is massive, they usually spread it out and exit over a couple of days. Now, what are we waiting for exactly in 3 days? Well, first of all, we're waiting for some kind of bullishness to show up. What that means is we can look for some kind of bullish candle, such as a reversal hammer. Or we can look for some sideways action, some consolidation, which shows the bottom might be near. We want to see higher highs every single day within those 3 days. We want to see a reversal pattern with volume. If we see a reversal without volume, that is probably a trap. So we got to be careful of that. And the most important part is we want to clear the 9 EMA. If it was a gap down, we want to see the price action to go above the EMA again. And if it's a gap up and you want to short, you want to see it go below the 9 EMA again. The reason why the 3-day rule works is because most of us, myself included, when I was a beginner, I feel like when there's a gap down, this is the best time to buy. I feel this 20% drop after earnings is the biggest discount and I cannot miss out on it. I feel a lot of FOMO, and that is when a lot of amateur traders enter and they think they get a discount, but they find out the next day the price drops a bit more. And then the next day after that, the third day, it drops more. Fourth day, fifth day, it keeps dropping. And they found out, hey, the first day drop was nowhere near the bottom. And that is the problem. And with this system, this 3-day system of waiting, it will really force you to wait 3 days and not be FOMO and to be patient. It's a very good framework for you guys to use. It's simple and highly effective. I'm going to go through some live examples right now to show you how it's used. So the first example here is Tesla. We had a gap down right here, big gap down. So we're going to count day 1 right here. Day 1, day 2. Day 2 is not bullish, so we reset the count. So this is day 1, day 2. Day 2, this is an inside bar. It's not bad. It's green, but it does not mean the reversal is here yet. So we're going to count this as day 2. Now day 3, this is not bad. It broke the high of the initial drop. It crossed the 9 EMA. This is a place where you can actually go long now. So this is the 4th day after the crash, and this is a much better place to long than trying to pick a bottom down here because it could have kept going down. Okay? Let's look at another example with Tesla over here. From here to here, after earnings, we had a gap down. A lot of people would say, oh, that's a 20% drop. That 20% drop is an excellent buy place. Tesla to the moon. No. That's not how we do it. So this is day 1 after the drop. So we start counting. Day 1, day 2. This is not a bullish bar. So we reset the count. Day 1, day 2, day 3. Not bad, but it's still barely poked past the 9 EMA. So I'm not going to take this trade. And look at what happened. We reset the count. Day 3, it went below. So we saved ourselves. Okay. Day 3 was a bearish bar. So we did not go long. Thank God we did that. So we reset the count. Day 1, day 2, not bad. Day 3, it dropped lower again. So we have to reset the count. Day 1, bad bar. Day 1, good bar. Day 1, day 2, day 3, not not bad. Now we're seeing some consolidation. However, it's not poking through the 9 EMA until here, which I think I would have entered long here instead. So yes, we did not pick the bottom, but picking the bottom is literally impossible. Nobody has a crystal ball. That would have been a good place to go long. So this 3-day rule would have saved us and also made us money. Let's grab another example. Let's look at AMD and look for an example here. So just by scanning it, we had earnings right here and it dropped like crazy. So we're going to count this as day one. And then the next day, this bar is really bad too. So we reset the count. Day one, day two, day three. This looks promising, but we did not poke past the 9 EMA yet. So we cannot go long. It looks a little bit sideways, but these are red bars. So we have to reset the count. So day one, nothing good here. We poke past the 9 EMA right here, but that's a gap up. So we have to reset the count also. Gap up, what, day one, because these are all red bars. These are no good. There's no reversal bullishness to it. So I didn't do anything. Now, this bar right here, this is a bottoming bar. I like that. So day one, day two, day three, this is consolidation now. I see a little box here at that time, and it poked to the 9 EMA, and this is a bullish bar. Okay, so somewhere around here we could have went long, and it would have done very well because it went sideways a bit more, and then finally it went up. We probably exited around here. Let's look at PayPal right here. Look at this gap down. So from here we had earnings, we gap down. So we start to count. Day one, bad bar. The next day is also a bad bar. Day one, day two, day three. Now we can start look for longs. However, we're so far away from the yellow line, 9 EMA, so we couldn't really do anything. So we had to keep waiting. It's consolidating. I like that. And once it passed the 9 EMA around right here, this bar, that's a very bullish bar. I like it. I would have entered here long, and look, it would have went sideways, but with our theta decay, we could have made money, and after that, we actually went up. So this 3-day rule would have saved you, would have prevented an early entry, and also give you a way better entry and a safer entry. Let's grab another example, a final one. Let's look at UNH. Right here. Earnings, huge gap down from 350 down to 300. Most people will think, hey, amazing, 10% discount. But no, I don't think that way. Look, let's do our counts. Day one, day two, day three, not a good bar. Day four, not a good bar. 5, bad. So they're all resetting the counts to day one. Day one, this is a good bar for day one. This might be a bottom. Day one, day two, day three, not bad, but we did not cross the 9 EMA yet. And until here, we actually crossed it on day 5. I would have went long right here, and then watch. It actually went sideways and then kind of went up. We probably exited our short put around over here. The decay would have done well. For sure, it's better than picking a bottom because there are so many instances where it goes down for multiple days. Look at this. Gap down, not even gap down, just straight down. Down. That's like, so if you don't count the 3-day rule, you would have, entered here, lose money, enter here, lose money, enter here, lose money, enter here, lose money. That is not a way to trade. That is not mechanical. That is not a good strategy. It doesn't work. I'll show you another final example. Gap down here again, 380 down to 330, down to 310. Wow, 20% drop. Good deal, right? Guess what? Next 2 days, it dropped even more to 250. Wow, that's a 30-something% drop. So if you try to pick the bottom and think this was a good discount, you're in big trouble. So traders, that's it for today. This is the 3-day rule. This rule will help you guys prevent any FOMO and early entries going forward for you guys. It saved me tens of thousands of dollars. I use this daily. I use it every earnings. I use it every time I look at the chart. Traders, trade small, trade safe.